Welcome to The Debate, where we dissect the most pressing questions in digital assets. Today we're diving deep into a fascinating and frankly critical dilemma for crypto investors as we look ahead to 2025. How do we build a truly robust risk management model for crypto and DeFi portfolios? The digital asset market now comfortably exceeds $1 trillion. It's constantly evolving, presenting both immense opportunity and pretty intricate peril. The central question for sophisticated investors really becomes this: should our primary focus be on navigating the powerful top-down forces? Things like macroeconomic factors, regulatory shifts, strategic portfolio allocation. Or should it be on a granular bottom-up assessment of the inherent technical and operational risks within individual protocols? I'll be arguing for prioritizing that holistic, macro-driven approach because I believe it offers the most leverage in today's landscape.
And I'll be challenging that. I'll be making the case for the foundational importance of understanding and mitigating those protocol-level technical and operational risks first.
Right. So, from my perspective, a comprehensive risk management model for crypto and DeFi in 2025, it simply must primarily integrate the evolving macroeconomic conditions, the unprecedented regulatory clarity we're now witnessing, and of course the accelerating influx of institutional capital. These aren't just, background noise. These top-down factors truly dictate broader market sentiment and present the most significant exogenous risks and opportunities. Consider where we are right now. The market's currently sitting in a rare neutral sentiment phase. That's a stark contrast to the historical, 62% fear or extreme fear. So this makes 2025 a period ripe for deliberate strategic positioning. We've seen the adoption of Bitcoin ETFs, the launch of BlackRock's Butyl Fund. These signal a deeper financial market integration that, I believe, fundamentally de-risks the space for long-term investors. And critically, the Genius Act, signed just this past July, legitimizes stablecoins as a regulated asset class with 100% reserve backing. Now, this isn't just a legal formality. It fosters a far more stable environment for DeFi by moving them from a somewhat ambiguous, often risky asset to a more predictable, regulated financial instrument. This clarity significantly reduces regulatory ambiguity, paving the way for even greater institutional participation. So therefore, a robust model, it should begin with a strategic allocation across asset classes. Bitcoin is digital gold, Ethereum is digital oil, and maybe a growth asset, especially noting the ETH-BTC capital rotation and surging on-chain activity we saw in August 2025, and real-world assets, RWAs, like tokenized U.S. Treasuries, for capital preservation. This kind of multidimensional slicing, it isn't just about diversification. It's about aligning your exposure with these macro forces, making sure your portfolio moves with the big currents, not against them. It offers a more resilient path through market volatility and allows investors to tune their portfolio to minimize risks from things like bad inflation, stagflation, or geopolitical tensions, while maximizing rewards from institutional adoption and utility growth.
Okay, that's a compelling argument, advocate. You're placing a lot of weight on those powerful macro shifts, and I appreciate the emphasis on strategic positioning. However, I worry it overlooks a fundamental truth about crypto. While yes, acknowledging the undeniable relevance of macroeconomic factors and regulatory developments, a truly effective risk management model for crypto and DeFi, particularly in 2025, it must first and foremost address the inherent and unique technical and operational risks at the individual protocol level. The exciting rush of innovation in crypto, it's always come with this crucial balancing act, right? Pushing boundaries versus ensuring rock-solid stability. And often, new innovations bring entirely new kinds of risks. Historical losses, they unequivocally demonstrate that smart contract vulnerabilities, economic design flaws, oracle manipulation, these are the most prevalent and impactful sources of financial loss.
We're talking about a median loss of $1 million and a staggering mean loss of $86 million from security incidents alone. These stark figures reveal a critical truth. In DeFi, security isn't just a feature, it's the bedrock of preventing catastrophic losses. Relying solely on a macro-driven strategy without deep dives into protocol security is, Well, it's akin to building on sand. The Sikith CEFT Pro framework, which is a well-recognized risk assessment model in our space, it zeroes in on critical areas like on-chain infrastructure security that holds a significant 25% weight. In risk assessment, rigorous smart contract audits, emphasizing reputable firms and timely remediation, and robust operational security controls. Issues like phishing, front-end vulnerabilities, poor key management, these are still highly significant for users. Furthermore, the varying incident frequencies across different chains, Ethereum and Binance Smart Chain, showing significant increases since 2018, contrasted with newer chains like Solana that benefit from architectural advancements but face new challenges like downtime, they underscore the pressing need for granular technical evaluation. A comprehensive model has to prioritize rigorous, bottom-up assessment of each token and DeFi trading opportunity based on its specific technical robustness, audit history, governance mechanisms, and crucially, its dependencies on external protocols like oracles. Ignoring protocol-level technical risks is, in essence, playing Russian roulette with your capital, regardless of broader market sentiment.
Dissenter, you've painted a stark picture there of protocol-level risks. And I agree, those figures on security incidents are, alarming. No one is arguing against the need for sound technical practices. However, for a sophisticated investor building a portfolio in 2025, the sheer scale of the macro shifts, from new regulations to global economic trends, well, it demands our primary strategic focus in tuning that portfolio. When we talk about the dominance of risk factors, the most significant ones to manage are truly those stemming from exogenous events and broad market shifts. Reports as recent as May 2025 indicate that stagflation has become a base case for the Federal Reserve. Now, historically, this boosts interest in alternative assets like Bitcoin and Ethereum as hedges, but, crucially, it increases overall market volatility across the board. Moreover, tariffs can further harm global growth and accelerate bad inflation, which directly impacts all asset classes, not just a single protocol. The Genius Act 2025 and the SEC FCTC Joint Statement 2025, they now provide unprecedented regulatory clarity, and that de-risks institutional participation, making the regulatory landscape a primary consideration for any investor managing a significant portfolio. Institutional capital flows, like the $1.3 billion into U.S. Treasury ETFs during stagflation concerns, also clearly inform a prudent defensive positioning. So if the Fed sees stagflation as a base case, and that drives capital into Bitcoin and RWAs, are we really going to worry more about a specific smart contract bug than a global economic shift? These macro forces, rather than, isolated technical glitches, will largely dictate success for buying in 2025 and holding for at least 1 year. Hedging strategies like, say, maintaining 30% USDT exposure in a portfolio are crucial for managing these systemic market risks and dampening overall volatility. This is where you tune for maximizing rewards and minimizing risk from the biggest external movers.
With all due respect, Advocate, I have to disagree on the primacy of macro forces there. In my view, they often act as a magnifying glass for inherent vulnerabilities rather than being the sole or even primary drivers of risk. Let me illustrate. While macro events are undoubtedly important, the Casualty Actuarial Society report emphasizes that risks like access control and the other category, which interestingly covers the highest frequency of incidents, are prevalent security challenges. Now, these are internal, design-related issues, not external market forces. Ethereum and Binance Smart Chain have shown a significant increase in incidents, highlighting the persistent challenges even on established chains. And the collapse of the Terra Luna ecosystem back in May 2022, triggered by a design flaw in its algorithmic stablecoin, demonstrates vividly how protocol failures can cause systemic risk across the broader crypto market.
A classic example, yes.
Exactly. Ether, Binance Coin, Cardano, Solana, Bitcoin, they all dropped simultaneously. This proves that inherent design risk can cause, not just respond to, market-wide distress. You talk about hedging with USDT, but what if the stablecoin itself is designed poorly? Imagine meticulously planning for every global economic tremor, only to lose everything because a single line of code was flawed. That's the stark reality we have to confront.
A robust model must quantify these underlying probabilities of technical failure using metrics like total value locked, TVL. That's the total amount of crypto assets locked within a DeFi protocol, as a crucial vulnerability indicator. Because, simply put, protocols with higher TVL attract more attackers. Ignoring this foundational layer of risk leaves your portfolio exposed to catastrophic internal implosions, regardless of the macro tide.
That's a powerful point about internal vulnerabilities, Dissenter. And the Terra Luna example is certainly a potent cautionary tale of design flaws cascading. Yet, for a practical risk model tuned for a 2025 portfolio, we still need to start by strategically slicing investments horizontally and vertically, based on utility, growth, potential, stability, with a constant eye on mitigating those macro impacts. For Layer 1s, the foundational blockchains, think Ethereum, its utility as digital oil, its post-merge deflationary supply, that makes it a key growth component for your portfolio. Now, while Solana has shown impressive gains, sure, its occasional outages raise reliability questions compared to more battle-tested chains. Newer L1s like Sui, they benefit from advanced architecture but, as you've noted, face new and evolving security risks. Within DeFi, real-world assets, RWAs, like those tokenized U.S. Treasuries from BlackRock and Franklin Templeton, they directly address the investor's capital preservation goal, acting as a critical hedge against broader market volatility. Lending protocols like Aave, which is battle-tested, diversified, offer a different risk-reward profile than, say, Spark, with its more specialized stablecoin focus. And for swapping on DEXs, decentralized exchanges, okay, yes, they carry smart contract vulnerabilities and slippage risk, but they often offer lower fees and non-custodial control, especially with solutions like Symbiosis that bypass separate bridge interfaces. And for measuring value, we can use something like what I call the crypto PE ratio, fully diluted valuation to annualized fee revenue. It's kind of like checking if a traditional company's stock price is justified by its profits, but here we're looking at the actual fees the protocol generates.
It helps us find projects that are becoming cheaper relative to earnings and ripe for strategic buying in 2025. This layered approach allows for granular selection within a macro-driven strategic allocation.
I understand that strategic allocation, advocate, and it's a useful way to think about diversification. However, when slicing a portfolio vertically, L1, L2, DeFi, and horizontally, specific protocols, the emphasis must fundamentally be on the inherent risks of each individual layer and protocol within that slice. For L1s, the inherent security of a blockchain's underlying technology and programming language plays a crucial role. It's true that newer blockchains benefit from architectural advancements, but they also face new security risks not present on battle-tested chains, including potential downtime. This just highlights that ever-evolving trade-off, innovation versus stability. For DeFi lending, over-collateralization is absolutely essential due to the pseudo-anonymous nature of the space. Platforms really should use a VAR-based haircut mechanism, a value-at-risk approach that dynamically adjusts the collateral needed, continuously recalculated, daily, maybe even minute by minute in stress scenarios to account for volatility, perhaps using something like EWMA volatility for pairs like ETHUSD. When it comes to DEXs and lending, reliance on oracles, like on the Maker platform, introduces oracle risk, the risk that external data feeds are manipulated or fail.
Absolutely.
Absolutely. This demands secure channels, multiple oracles, and time-weighted average price, TWAP, to avoid manipulation, as the Mango market hack demonstrated so vividly. Even with increasing institutional involvement, the persistent risk of impermanent loss in liquidity pools, where the value of your staked assets declines relative to simply holding them due to price movements, it requires specific mitigation strategies, like focusing on stablecoin to stablecoin pairs. These are the fundamental points that dictate security and sustainability, regardless of how neatly you slice your pie from a top-down view.
Dissenter, you're rightly pointing to critical internal mechanics, and I concur that specific protocol vulnerabilities are paramount. But the scope of systemic risk in DeFi, stemming from these deep interdependencies where distress in one protocol propagates to others, that truly demands a broader, top-down mitigation strategy. our model needs to incorporate contagion propagation, for instance, using rolling correlations like that ETH-BTC spike we observed during the May 2021 Bitcoin crash. It also requires volatility stress testing, for example, modeling the impact of a, say, 30% shock across the entire portfolio. An ongoing monitoring and rebalancing plan is essential, guided by clear metrics and predetermined actions. This holistic view also has to acknowledge market manipulation practices, wash trading, pump and dump schemes, which are often harder to detect in DeFi than in traditional finance because of pseudonymity. Furthermore, the evolving regulatory landscape, while generally de-risking as we discussed, still presents regulatory risk and unclear tax implications. These can create systemic challenges for investors, particularly for a 2025 portfolio with a longer hold period. Monitoring overall protocol health metrics and ensuring compliance with KYC/ML procedures are crucial to navigating these systemic issues, which can impact an entire portfolio irrespective of a single protocol's technical perfection. So yes, while a smart contract audit is vital for a single protocol, understanding the regulatory wins or the potential for broader market manipulation is what protects the entire investment strategy.
I understand the concern about systemic risk, advocate. I really do. But I fundamentally believe the greatest defense against that very systemic risk in DeFi is robust mitigation of specific protocol failures, because those are often the triggers for wider contagion. If we don't fix the leaks in the individual boats, the entire fleet is at risk no matter how calm the ocean seems. This demands rigorous bottom-up practices, independent security audits of smart contracts before deployment, a strong risk management culture embedded within protocol teams, and a well-defined incident response plan. Without these, you are simply waiting for a systemic event to be caused by an internal flaw. We need continuous automated real-time monitoring leveraging machine learning, incident reports to detect attacks in progress. Think MEV attacks like sandwich attacks, where malicious actors front-run transactions, or phishing attempts, and provide early warnings for liquidity risk, the protocol. Additionally, protocols must demonstrate adequate capital reserves and use over-collateralized loans with healthy secondary markets for liquidators. This helps mitigate credit and liquidity risks, as fixed liquidity adjustment mechanisms can actually exacerbate market risk during stress. If you don't address these specific foundational weaknesses, you're just patching symptoms while the underlying disease festers, waiting to ignite a broader crisis.
Well, today, we've explored two distinct, but I think we agree, vital perspectives on building a truly comprehensive risk management model for crypto and DeFi portfolios in 2025. I've presented the case for integrating broad macroeconomic factors, the transformative impact of regulatory clarity, and institutional capital flows into a strategic, top-down portfolio allocation. This approach emphasizes navigating the macro environment and strategically choosing asset classes and layers to manage those exogenous events, aiming to both minimize risks like stagflation and geopolitical tensions and maximize rewards from institutional adoption and utility growth. It's really about ensuring your portfolio is resilient to the biggest external forces.
And I have underscored the foundational necessity of a granular, bottom-up assessment of inherent technical and operational risks within individual protocols. My argument boils down to this: smart contract vulnerabilities, oracle risks, economic design flaws. These are primary drivers of loss, regardless of broader market conditions. And these risks originate within the ecosystem, often cascading outwards to create systemic problems. Without robust protocol-level security, even the calmest macro seas can't prevent a shipwreck.
What becomes clear, I think, is that navigating the evolving digital asset landscape in 2025 requires a truly multifaceted approach. We must acknowledge that both the forest of macro trends and the trees of individual protocol mechanics present unique, significant challenges.
Exactly. As the market matures, sophisticated investors will need to continuously adapt their strategies, balancing these perspectives to make informed decisions and manage risks effectively. There is certainly more to explore in this complex and fascinating domain, and the interplay between these forces will continue to shape the future of digital asset investing.